Triple-digit silver isn't a meme again. It's a math problem the market is already stumbling into. And the people trying to frame this as just another blow-off top are betting you won't look at the one place silver can't fake it. The structure around delivery, spreads, and forced flows that hit the tape on a calendar, not on your feelings. Right now, silver is sitting around the low 70s per ounce after printing an all-time high in the low to mid-80s in late December. And that alone is enough to trigger the usual script. Overbought, speculative froth, retail mania. It has to cool. But here's the uncomfortable truth. In silver, cooling off isn't a debate between bulls and bears, it's a logistics question. Who can actually source metal on time, at size, without paying up? And that's where the real pressure starts. Because the headline price is only the last place stress shows up. The first place it shows up is in what the market is willing to pay for silver now versus later, and what it forces the short side, the hedgers, and the passive flows to do when they're all pointing at the same exit door on the same week. Keep that in mind, because later I'm going to give you the specific levels and the specific 2-week checklist that matters more than any headline. And one of those levels is the kind that changes behavior, not just sentiment. But we have to build the mechanism first, because if you don't understand the mechanism, you'll get emotionally timed out right before the move that makes the whole thesis obvious in hindsight. And silver loves humiliating people who only have one story in their head. Now, let's talk about the conflict, because it's real. There's a force that wants this move to feel like a short-lived frenzy, partly because it's a comforting narrative, and partly because the institutions that live in derivatives markets need orderly markets to manage risk. When volatility explodes, margin goes up, liquidity thins, and weak hands become a supply source for strong hands. That's not a conspiracy, that's market structure. You saw it in real time at the end of December when the exchange raised margin requirements on silver futures, and price immediately got punched in the face intraday, because leverage is a fragile scaffold. Raise the cost of holding that scaffold, and some people have to liquidate even if they're right. And that's the first psychological trap. Silver can drop hard for reasons that have nothing to do with the big picture. That whip is a feature, not a bug, but that's not the part that matters. The part that matters is what happens after the forced selling. Does price rebound on thin offers? Do spreads refuse to relax? Do physical premiums stay sticky? Because if those things stay tight, it means the market isn't correcting, it's rationing. And rationing is how you get a step change move that looks impossible until it's already behind you. So here's your map of where we are. Silver just put on a move that would have been considered decade level in the old regime, and it did it in months. It made a December peak in the 80s, then snapped back into the low 70s as the market digested margin changes and year-end positioning, and as January opened. It started to behave like a market that's trying to decide whether it's going to consolidate or whether it's going to squeeze. And if you think that's just chart talk, watch what comes next. Because the calendar is the catalyst, and the calendar doesn't care what you believe. In the second week of January, specifically the January 8th to January 14th window, you have a mechanical flow event tied to major commodity index rebalancing that can force meaningful futures selling in metals. That means silver can get hit with selling pressure even while the underlying physical story tightens. And when you get that split, paper selling into physical tightness, you get the exact kind of dislocation that creates the next leg. That's the hidden setup most people miss because they're staring at the spot chart, waiting to be told what to think. Everyone's watching the headline price, but the signal is somewhere else. The signal is in the curve, the spreads, the inventories that are actually deliverable, and the way passive money moves on a schedule. And when those signals line up, triple digits stops being a dream and starts being a probability tree. Here's the hidden detail that reframes the whole story. The silver price you see is a blend of financial liquidity and physical constraints, and those two things don't move smoothly together. In calm times, silver behaves like a paper market. Deep futures liquidity, tight spreads, easy roll, and the spot price looks like the whole truth. In stressed times, the market becomes a timing market. Not will you own silver, but can you get silver now? That is why term structure matters. Term structure is just the market's way of pricing time. In a normal, well-supplied market, you often see a gentle contango, futures priced a bit above spot, because storage, insurance, and financing cost something. In a tight market, that relationship can flip. Nearby contracts can trade richer than farther out contracts. That's backwardation, and it's the market shouting, I'll pay extra for immediacy. In other words, the price is lying and the spread is telling the truth. And if you're wondering how you can have backwardation while vault holdings exist somewhere, welcome to the difference between metal exists and metal is available at the margin, in the right form, in the right place, under the right rules. That's the difference between eligible and deliverable, between warehouse totals and registered stock, between somebody's long-term custody and someone's willingness to part with bars when demand spikes, Silver trades like a financial asset until someone demands delivery, and then it trades like a supply chain. And supply chains don't respond on Twitter timelines. They respond on lead times. This is where market structure becomes the story. A standard COMEX silver futures contract represents 5,000 ounces. It's clean, standardized, and liquid. But the actual system that backs it has categories, rules, and frictions. Metal can sit in approved warehouses and still not be for sale in the way people imagine. Owners can reclassify, move, finance, or simply refuse to deliver unless they're paid enough. And in tight periods, that's exactly what happens. The market has to pay for willingness, not just for metal. That's where the real pressure starts. Now layer in the why now, because without the calendar trigger, you don't get the near-term roadmap, you just get vague bullish vibes. January is a trapdoor month. Liquidity is patchy. Funds rebalance. Commodity indices reset weights and force passive products to realign exposures. Options positioning rolls forward. And the key detail is that some of these flows are not discretionary. They are mandates. If an index methodology says, reduce weight here and increase weight there, then products tracking it have to trade it, even if they disagree, even if it's painful, even if the story is bullish. So you can get a sharp downdraft that has nothing to do with silver is over. It can be pure mechanical selling, and that's why the next 2 weeks matter. Because if the market can absorb that forced selling without breaking key levels, and if the structural signals stay tight, then the math starts to tilt toward a continuation regime. But there's another why now that's even more explosive, and it's not a chart pattern. It's policy and supply chain control. Starting January 1st, China put in place new export licensing procedures for state trading enterprises covering a basket of metals that includes silver. Translate that into market reality. If export access gets narrowed to a smaller set of approved channels, global buyers don't just worry about price, they worry about reliability. They worry about timing. They worry about whether supply can be diverted domestically when industrial demand rises. And silver is uniquely vulnerable to that kind of policy friction. Because, unlike gold, silver is not purely a monetary store. It is consumed. It gets used up in electronics, solar, industrial applications, and 1,000 small components you never see. That consumption creates a steady baseline bid that doesn't care about your chart. And when industrial users feel uncertainty about sourcing, they don't politely wait for price to calm down. They pre-buy, they hedge, they lock in, they do procurement panic. That's where the move becomes math, and that's where the real pressure starts. Now, before we go any further, you need the clean mechanism explainer that turns this from silver hype into silver structure. There are two big pathways to a violent upside move in silver, and they can happen together. Pathway 1 is physical versus paper tension. Tightness in immediate supply and delivery-related stress that shows up in backwardation, premiums, and inventory categories. Pathway 2 is positioning and margin dynamics. Shorts, hedgers, and leveraged longs getting forced to act in the same direction, often through short covering and reflexive momentum. Let's start with the physical mechanism, because it's the underappreciated driver that makes the whole story coherent. Supply in silver is not a simple faucet. A large portion of mined silver comes as a byproduct of mining other metals like copper, lead, zinc, and gold. That means even if silver price spikes, miners don't magically double silver output next quarter. They respond to their primary metal economics, their capex cycles, their permitting timelines, and their refinery capacity. And refineries are not instant either. You have lead times, constraints, and quality specs. Recycling helps, but recycling is also price dependent and capacity limited. It ramps with a lag, and it tends to arrive after price has already moved. So when industrial demand climbs and investment demand returns, the market can run deficits for multiple years without an easy supply response. This is why the Silver Institute has been forecasting a sizable deficit repeating for years, driven heavily by industrial demand. Deficits don't have to be catastrophic in a single year to matter. The cumulative effect matters. Each year of deficit is like shaving the cushion thinner. Eventually you don't get balanced, you get fragile. And a fragile market doesn't need a huge new demand shock to spike. It needs a small marginal squeeze, one policy friction, one procurement wave, one delivery window, because the buffer is gone. That's the hidden detail. The buffer is the story, and that's where the real pressure starts. Now stack proof on top of that mechanism, because this can't rest on one argument. Proof point 1 is the term structure signal. When nearby silver is bid relative to forward months, it tells you there's urgency for immediate metal. Even when the spot chart is wobbling, backwardation is the market's lie detector. Proof point 2 is inventory nuance. London Vault data shows massive quantities of silver sitting in commercial vaults, tens of thousands of tons, but the number moving up or down doesn't directly translate to available float. Vault holdings can rise because metal is moving into custody for financing, for ETF settlement, for OTC flows, or because arbitrage moved it from one hub to another. In other words, Metal can be there and still not be for sale at the price you want. Proof point 3 is exchange behavior. When volatility spikes, exchanges raise margin. That's risk management. But it also creates forced liquidations and short-term price dislocations. The late December margin hike is a perfect example of how the system tries to cool the tape when things get too fast. And that matters because if price recovers after margin-induced selling, it signals underlying strength, not just speculative froth. Proof point 4 is institutional flow mechanics. The Bloomberg Commodity Index rebalancing window in mid-January is a known flow event that can create outsized selling pressure in silver relative to its liquidity. Analysts have been openly talking about the scale being meaningful relative to open interest. If you convert even a few thousand futures lots into ounces, you are suddenly talking about tens of millions of ounces of paper pressure hitting a market that is already sensitive to supply timing. And here's the key, that selling is not bearish fundamental money. It's passive adjustment. It creates air pockets. And air pockets are where strong hands accumulate, but that's not the part that matters. The part that matters is what the market does after it absorbs those air pockets. Proof point 5 is policy friction and trade flow uncertainty. The introduction of export licensing procedures for silver in China doesn't need to shut exports off to matter. It only needs to increase uncertainty, slow approvals, and push buyers to seek non-Chinese sources, which can widen regional premiums and increase competition for deliverable material. Even if total global supply is unchanged, the distribution of supply can become the constraint. That's the global arbitrage angle. If one region tightens and another region must import, price becomes a magnet across hubs. It pulls metal, it pulls spreads, it pulls premiums, and that's where the real pressure starts. Now layer in proof point 6, because we're not stopping at 5. Proof point 6 is behavioral and reflexive dynamics. When silver is in a volatility regime, it doesn't trend quietly. It trends through pain. It creates dips that feel like betrayal, then rips that feel unfair. That pattern is not random. It's how leveraged markets clear. A dip forces weak longs out and forces shorts to get comfortable again. Then the rebound forces shorts to cover and forces sidelined money to chase. That chase can turn into a squeeze when liquidity thins. And liquidity in silver does thin fast. Silver is deep until it isn't, and when it isn't, price jumps. That's how you get gaps and air pockets that leave people staring at the chart thinking, how did it move that far that fast? Because if this one level breaks, the math changes. Now we need to talk about the other pathway, positioning and margin spiral risk. Silver is a futures first price discovery market. That means a lot of the action is in leveraged instruments. When the market runs, traders pile in, open interest rises, options activity can rise, dealers hedge. When volatility rises, margins rise. And here's the uncomfortable feedback loop. Higher margin forces de-risking. De-risking can push price down triggers more de-risking, and then when it stabilizes, the absence of sellers creates a vacuum. That vacuum is where the upside becomes violent. And if you add shorts into that mix, especially hedged shorts or speculative shorts, the reversal is amplified by short covering. Short covering is not bullish conviction, it's forced buying. It's buying because you can't afford not to. And forced buying is the most aggressive buyer there is, because it doesn't wait for value. It pays the offer. That's where the real pressure starts. Now, how do you translate this into the triple-digit question without turning it into a fantasy? You do it as a sequence, not as a straight line. Triple digits doesn't require one day of insanity. It requires a chain of events that are all plausible in a tight, leveraged market with calendar-driven flows. Step 1, the market stays in a high volatility regime and refuses to break structure on dips. Step 2, mid-January rebalancing selling hits, and instead of collapsing, silver holds a key support zone and rebounds quickly, showing that bids are real and size is waiting. Step 3, spreads and term structure remain tight, suggesting physical urgency hasn't relaxed. Step 4, policy and industrial procurement keep the baseline bid firm, especially if buyers perceive export licensing friction or supply chain risk. Step 5, price reclaims the prior breakout zone and starts to pull in systematic trend followers and momentum flows that operate on rules, not opinions. Step 6, a final attempt to cool it down through margin or narrative triggers another dip that gets absorbed even faster. Step 7, the next squeeze leg begins and the market moves in jumps, not steps, because liquidity thins and hedgers get trapped. That's the path. And it's exactly why triple digits is not a promise. It's a conditional scenario that becomes more likely as the market keeps passing stress tests. But you have to respect the counterpoints because silver can stall without anyone cheating. Here are the clean ways this can fail or pause. 1, real yields and the dollar can surge, especially if inflation expectations roll over faster than nominal rates, tightening financial conditions and pressuring precious metals. 2, Industrial demand could slow if growth expectations crack, if solar deployment slows, or if inventory destocking happens in the supply chain. 3. Substitution can creep in at extreme prices. Not because engineers love it, but because procurement departments start forcing alternatives, even if performance suffers. 4. A recycling wave can add supply, especially if high prices unlock scrap. 5. Regulators and exchanges can keep raising margin and tightening risk controls, making it harder for leverage longs to persist. 6. The market can simply exhaust itself short term. Too many people chase, too many profits get taken, and the tape needs time. None of that kills the long-term story automatically, but it can change the near-term path. And that's why you need a 2-scenario lens right now, not a single heroic narrative. Scenario 1 is controlled pullback and retest. In this scenario, silver consolidates in a broad range, it tests support, and it takes time. It looks boring, it looks disappointing. Headlines declare it over, but the structure holds. Spreads don't collapse, dips get bought. This scenario is constructive because it resets positioning and builds a base for the next move. Scenario 2 is continuation squeeze. In this scenario, silver refuses to give you the perfect dip. It holds above a key zone, reclaims momentum quickly after rebalancing, and then it gaps. It moves in bursts. It creates the kind of price action that makes people feel late and makes shorts feel trapped. This scenario is dangerous because it can be followed by violent snapbacks, but it's also how you get upside acceleration. And here's the psychological shield you need, because most people lose in silver, not because their thesis was wrong, but because the volatility hacks their decision-making. Silver will do 3 things to manipulate you emotionally. First, it will drop fast right after you buy and make you feel stupid. Second, it will chop sideways and make you feel bored and doubtful. Third, it will rip higher without you and make you feel panicked, and that panic will push you into chasing at the worst moment. If you don't recognize that pattern, you'll become liquidity for someone else. The antidote is simple and unsexy. Separate trend signal from noise and define your time horizon before the market defines it for you. Trend signal is structure holding, spreads staying tight, and price respecting key zones on the higher time frame. Noise is intraday spikes, social media headlines, and margin-driven air pockets that reverse quickly. If you treat noise like signal, you will sell lows and buy highs. If you treat signal like noise, you'll get shaken out right before the move. And that's where the real pressure starts, inside your own behavior. Now let's make this actionable. What should you watch in the next week or two, specifically, in a way that respects both scenarios? Start with the calendar. The January 8th to January 14th rebalancing window is your first stress test. Watch how silver behaves into that window and coming out of it. If silver is drifting lower into the window on light volume and then finds aggressive bids and snaps back after the flow passes, that's a bullish tell. If silver breaks down hard, cannot reclaim lost levels, and the bounce is weak and sold, that's a caution tell. Next, watch the key levels that change behavior. I'm going to frame them as zones because silver in this regime will pierce levels and then decide after. The first zone is the post-December pullback support band in the high 60s to low 70s area. If silver repeatedly holds that zone and rebounds, it tells you dips are being accumulated and the market is refusing to reset lower. The second zone is the mid-70s to upper 70s area, which acts like a pivot. Above it, momentum funds start to lean in again. Below it, skepticism grows and volatility spikes. The third zone is the psychological $80 handle, because it SM close to the recent highs and it ESA where the narrative turns from rebound to a breakout. If silver clears $80 and holds it on a closing basis, it invites the next wave of momentum and forces shorts to respect risk. The next zone is the prior peak area in the low to mid 80s. That's where breakouts get tested. A clean break and hold there shifts the probability towards scenario 2. A failure there can still be constructive if it forms a higher low afterward, but it can also be the start of a deeper pullback if it cascades. Now, what would confirm the bullish thesis quickly? 1, silver holds that high 60s to low 70s support band through the rebalancing window and recovers quickly. 2, silver reclaims the mid to upper 70s pivot and turns it into support. 3, silver pushes back above $80 and the move is not immediately reversed. 4, the curve and spreads continue to signal tightness, meaning nearby demand doesn't relax even when price is choppy. 5, physical availability symptoms, premiums, delivery urgency, or procurement behavior stay sticky. You don't need every piece of evidence to scream at once. You need the stack to remain consistent. What would weaken or invalidate the near-term thesis? A decisive breakdown below the support band that doesn't reclaim quickly, especially if it happens with heavy liquidation and spreads relax in a way that suggests urgency is gone. Another invalidation signal would be a strong macro reversal. Real yields sharply higher, dollar sharply higher, combined with declining industrial demand expectations that take the floor out from under the physical bid. And there, that's a third invalidation, that S purely behavioral. If the market turns into a one-way mania where everyone is all in and leverage is extreme, that can set up a brutal flush, even if the longer trend is intact. The market punishes certainty. Silver punishes certainty faster. Now, let's talk about targets, because you were promised concrete payoff, and you deserve it in a way that doesn't pretend we can see the future. Think of targets as magnets, not guarantees. If silver reclaims $80 and holds, the next magnet is a full retest of the recent highs in the low to mid 80s. If it breaks that and holds the next magnet, becomes the round number psychology and the positioning impact in the 90s, because that S, where a lot of people start recalculating what fair value even means in a deficit supply friction environment. And if the market transitions into scenario 2, a continuation squeeze with thin liquidity, triple digits becomes the next psychological air pocket. Because once you're above prior highs in a market with forced buying and structural tightness, the move often overshoots what fundamentals would justify in a calm world. That's what squeezes do. They compress time. But here's the risk framing that keeps you sane. Even if the thesis is correct, price can whip around violently. A correct thesis does not protect you from drawdowns. It protects you from being blindsided by the direction of the larger move. Your job is not to win every tick. Your job is to avoid being forced out at the worst moment. And that means respecting volatility, sizing like a professional, and keeping your eyes on signal, not noise. Remember what volatility does. It offers you a reason to do the wrong thing at exactly the wrong time. It gives you a headline. It gives you a red candle. It gives you a bubble narrative. It gives you a margin hike. It gives you a fake sense of certainty. And then it takes your position right before the market resumes its path. That's the trap. And that's why the best silver investors aren't the loudest, they're the calmest. They understand that in a market driven by supply chain lead times, term structure pressure, and calendar-driven forced flows, the tape will try to shake you loose. That's not a bug. That's how the market transfers metal from weak hands to strong hands. But that's not the part that matters. The part that matters is whether the market keeps telling you, week after week, that immediacy is expensive, that physical urgency exists, and that dips are being used for accumulation rather than distribution. Now, one more important detail before we close, because this is where people misread what higher prices actually do. High prices can reduce some demand at the margin. They can also increase supply at the margin. But silver is not a market where you can assume high price quickly fixes the imbalance. Byproduct supply doesn't surge overnight. Refinery constraints don't vanish. Policy friction doesn't get smoother because you wish it. And industrial demand doesn't disappear because it's baked into long-duration trends like electrification, solar deployment, and data infrastructure. What changes first is behavior. Producers hedge differently, users procure differently, funds allocate differently. And when those behaviors change, price discovery changes, the market stops being a price chart and becomes a competition for time. Who can wait and who can't? Who has to roll and who has to deliver? Who has to rebalance and who has to hedge? And that is why this setup is so dangerous for the shorts and so confusing for casual observers. The chart is just the footprint. The mechanism is the animal. So here's your near-term checklist, and if you do nothing else, do this. Watch the January 8th to January 14th window and the days immediately after it. Watch whether silver holds the high 60s, low 70s support band or breaks it decisively. Watch whether silver can reclaim the mid to upper 70s pivot quickly. Watch whether $80 flips from resistance into support. Watch whether a retest of the December highs gets accepted or rejected. And keep one eye on the I lie detector, the structure around the price. Because if spreads and urgency stay tight while the chart is noisy, it means the underlying story is still pressurized. If those structural signals relax at the same time, price breaks support, respect it, because it means the market is buying time, not launching. And hold that two-scenario lens the whole time. Scenario 1 is a controlled retest that looks ugly and then resolves higher. Scenario 2 is a continuation squeeze that leaves you no perfect entry and punishes hesitation with gaps. Both scenarios can still lead higher. The difference is how you manage your emotions in the middle. If you are actually the kind of investor who wants to understand what is really happening instead of being hypnotized by headlines, you're already ahead of most of the crowd. Stay in that identity. Watch structure, not slogans. Respect volatility, not vibes. And if you want more of these market structure breakdowns, where we translate what the futures curve, inventory categories, and forced flows actually mean into a clean weekly roadmap, then stay close to this community. Because the edge isn't secret information. It's disciplined attention to the right signals when everyone else is distracted.